I am going to call Tokenization, which is sort of our tongue-in-cheek answer to the...
Welcome to Nasdaq TradeTalks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. We're coming to you live from Consensus in Austin, Texas. Joining me for this segment, we have Robert Leshner, co-founder and CEO of Superstate. We're here to discuss what's next for tokenization and the infrastructure regulation partnerships that are needed for secondary market use cases. Robert, it's great to see you again. Welcome back to TradeTalks. You specialize in tokenization of real-world assets, particularly around tokenization of securities. How would you describe the environment right now? Is there still more work to be done in terms of infrastructure?
Well, the environment right now is incredibly optimistic. And we're optimistic because right now the legal and regulatory picture in the US is getting more exciting by the week. There's a lot of enthusiasm that there's going to start to be more legislation crafting rules for the crypto industry that's going to potentially have a huge impact on securitization and tokenization. I think outside of that, there's a lot of excitement also on the growth of most of the new tokenization efforts. So Superstate has had a lot of growth recently. BlackRock's Biddle Fund has had a huge amount of growth. And we've seen the numbers go from essentially zero to over $1 billion over the last couple of months. And so it's an exciting time.
It definitely is. When we think about secondary market usability when it comes to tokenization, what are some of the positive points? Why would you think about tokenizing assets?
Well, the primary reason to tokenize assets is that they're going to be more useful and have more functionality than they do in a traditional administration and recording of ownership. So when you own a share of stock or when you own a bond, that's pretty much it. It sits on a ledger, and there's many different ledgers, and they don't always agree, which is one of the core reasons to tokenize in the first place, but they sit on a ledger and that's it. When an asset is tokenized, the optimism around it is that it's able to be traded, it's able to be integrated and composable with different applications on-chain, whether it's a lending protocol, whether it's a decentralized exchange, whether it's a custom, smart contract that two institutions set up to make settlements between the two institutions. Once it's on-chain, it doesn't just sit there anymore. Suddenly there's a whole universe of things that you can do with the asset. And that's what everyone is excited about.
Does it remove intermediaries?
Well, in some ways it does, and in some ways it creates a different market structure. One of the primary advantages of an open blockchain is that there's a single source of truth around ownership. And so, in some ironic sense, there's a lot of centralization in that there's only one recording of who owns what, versus an asset being owned in 20 different ledgers or 100 different ledgers. And so, what's interesting about this is it removes a huge number of intermediaries in traditional market structures. What it does is it opens up the assets to be able to be composable and usable in new protocols, in new markets, and in new applications. And so you can think of them as intermediaries potentially, although they're most likely autonomous, smart contract-based intermediaries.
It's so interesting when you think about the ethos of decentralization. And as you see more increased institutional adoption, it removes some of the decentralized characteristics, do you think? We know institutional adoption is happening in terms of capital markets, but the actual ethos around decentralization, is there any pushback there?
Well, there is. So, the primary tension that exists right now is that, proponents from the crypto industry, think of decentralization in a couple ways, and capital market participants think about it differently. So in crypto, people think about decentralization as whether or not the blockchain environment is secure, whether or not there's a lot of different validators that are enforcing the rules of the chain, right? Whereas in traditional capital markets, people think about decentralization as a bad thing. They say, we like centralization where, all of the market is in one place, there's not 20 different markets. And so capital markets think about centralization in terms of liquidity, and a lot of times crypto thinks about centralization and decentralization in terms of economic security of processing transactions. And these are like oil and
it sounds like it's going to be integrated, right? To have an either-or situation, it's just not going to advance the principles of it.
That's right, and so I think we're going to get a best of both worlds approach over time, and it's going to take years to get to this end state, but what we're going to see is blockchains where the security of the transactions, the validity of them is incredibly decentralized, and that there's a huge amount of confidence that the blockchain functions correctly because of that decentralization. On top of those blockchains, we're going to see assets that are issued and tokenized that are actually more centralized in a good way than traditional financial markets, and that there's going to be a single source of truth at all times about who owns an asset. Every market participant will know in real time who owns it and how that happened. And that's different from traditional market structure, which in some sense is incredibly decentralized in a bad way.
Right.
And this is what leads to huge amounts of back office and reconciliation, why markets are still T+1 and not T+12 seconds.
Oh, we just got to T+1 on yesterday. What's
Yesterday.
Wednesday? Just yesterday. So we'll see if it ever gets to T+0. But to wrap up here, speaking specifically to Superstate, tell us where you fit within the ecosystem. What kind of work are you doing there?
Sorry, can you repeat the question?
Superstate specifically.
Yeah, so Superstate launched our first tokenized fund, which is a T-bill fund essentially, earlier this year. Since then, it's grown to over $100 million of assets. And what's coming up next is integrating this asset, which is now a token on chain for qualified purchasers, into the benefits and the best of the applications that exist on chain. So integrating it into decentralized trading venues, integrating it into lending protocols, and integrating it into off-chain crypto service providers and intermediaries like custodians, brokers, and other systems.
I appreciate the insight. Thanks so much for joining us on Trade Talks, and thanks for joining us from Consensus. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.